The world of finance has undergone a seismic shift with the rapid advancement of information technology, particularly in the realms of investing, lending, and payment services. Mobile payments, a prime example of this transformation, have become an integral part of our daily lives. By 2024, over 4.3 billion people worldwide embraced this technology, with adoption rates surpassing 80% in countries like China, India, Kenya, Singapore, South Korea, Sweden, and Tanzania. However, the true impact of mobile payments often goes unnoticed, as they are typically associated with small, everyday transactions and are linked to existing credit or debit cards in advanced economies. In our study, we delve into the real effects of FinTech by examining Singapore's nationwide mobile payment rollout in 2017. Unlike previous studies that focused on the impact of FinTech on individual sectors like households, merchants, or financial intermediaries, we take a holistic approach. We explore how mobile payments simultaneously reshape these sectors and how their interactions amplify the overall economic impact. Our research goes beyond the obvious, showing that mobile payments not only spur small business formation and alter consumer spending habits but also crucially depend on how traditional financial institutions, especially banks, adapt their payment and credit strategies in response to this technological shock. Singapore provides an ideal setting for our study. Despite a high smartphone usage rate of 73% and near-universal banking coverage of 98% in 2016, only 3% of retailers accepted mobile payments, with cash still dominating 60% of transactions. In 2017, the government's push for digitalization, coupled with banks' development of supporting infrastructure, set the stage for a mobile payment revolution. DBS Bank led the way with the launch of QR code payments in April 2017, offering low-fee, instant, and secure mobile transactions that soon became industry-wide. The introduction of PayNow on July 10, 2017, by the Association of Banks, further revolutionized mobile payments in Singapore. This system allowed fee-free interbank transfers via mobile or ID numbers, a feature lacking in similar systems like the US FedNow, which was launched in July 2023. Using business-level data from Singapore's Accounting and Corporate Regulatory Authority and transaction-level data from 138,448 representative customers of DBS Bank, which served 82% of Singapore's residents, we tracked the rapid rise of mobile payment adoption. Within a year, mobile payment use soared from 8.6% to 33.4%, sign-ups increased from 31.9% to 47.9%, and transaction values multiplied tenfold. We hypothesized that the widespread adoption of QR payment technology would reshape the business landscape, consumer behavior, and the retail banking sector. To test this, we compared changes before and after mobile payment adoption between an affected group and a distinct control group, controlling for industry, time, and interaction effects. Our findings revealed that mobile payment adoption offered the greatest benefits to small, cash-reliant merchants. By lowering transaction costs, speeding up payments, improving record-keeping, and reducing cash handling risks, mobile payments drove business growth. We compared business entries in consumer-to-business, C2B, and business-to-business, B2B, industries after the adoption of PayNow in April 2017 but before the introduction of PayNow Corporate in June 2018. Entry rates were similar before April 2017 but diverged sharply afterward, with C2B entries rising by over 18% relative to B2B, resulting in a cumulative increase of 268% in the 15 months following. Further analysis confirmed this pattern. Excluding ambiguous sectors strengthened our results, and cash-heavy industries and low-income neighborhoods showed the largest entry gains. No effects were observed in affluent or tourist districts. The C2B-B2B difference disappeared after June 2018 when PayNow Corporate extended mobile payments to B2B transactions, confirming the C2B specific effect. Among DBS clients, 3.7% were self-employed. After mobile payment adoption, this group experienced statistically significant increases: 6.9% higher cash inflows, 2.9% higher outflows, 2.9% lower liquidity holdings, and 3% higher spending. These results suggest that Singapore's mobile payment rollout enhanced the formation of small businesses, increased income, and improved operational efficiency for self-employed merchants. We also examined consumer responses to mobile payment adoption. Using DBS data, we identified affected consumers as adopters of Paylar, DBS Bank's digital wallet launched in 2014, between April 2017 and the rollout of PayNow. We matched these adopters to similar non-adopters based on pre-2017 demographics and financial information. From April 2017 to April 2018, adopters showed clear differences. Mobile payment spending rose by SGD 3.1 per month, ATM withdrawals declined, total and credit card spending increased, and bill payments remained unchanged. Overall spending rose by 4.1%, equivalent to SGD 172 monthly, SGD 2064 annually, per consumer, resulting in an annual aggregate spending increase of over SGD 100 million in our sample, which was only 5% of the DBS consumer base. Our findings suggest that the spending increase was not driven by income growth but rather by eased liquidity constraints and increased purchases from small merchants. Credit card data confirmed more frequent and higher value transactions at small retailers. The increase in credit card spending could be attributed to banks expanding their credit card facilities. We found no signs of impulsive or debt-driven spending, as delinquency rates and spending composition remained stable. The adoption of mobile payments also prompted banks to adjust their retail strategies. Before QR payments, approximately 3 to 3.2 million Singapore residents held cards, but cash still accounted for 60% of transactions. The rise of free mobile payments led banks to streamline ATMs and expand credit card offerings. DBS data showed accelerated ATM closures in cash-heavy, low-cost districts, while credit card ownership, the number of cards per user, and credit limits all increased. Mobile payment users were 1.6% more likely to become cardholders. Our study highlights the tangible economic impact of low-cost digital payments and underscores the need to explore their broader welfare effects. Within a year of Singapore's rollout of consumer-to-business mobile payments, we observed three key shifts. 1. Increased small business formation, with self-employed owners experiencing higher revenues, lower liquidity needs, and greater spending. 2. Consumers benefiting from eased cash constraints and increased total expenditure, utilizing both mobile payments and credit cards as their credit access expanded. And 3. Banks reducing ATM deployment in historically cash-intensive areas while expanding credit provision. These findings demonstrate the transformative power of FinTech and the need for further research to understand its full potential and impact on our financial landscape.